Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hi, everybody. Welcome to the 9th edition of the Facts versus Feelings podcast with Ryan and Sonu. Sonu, we are recording this on Tuesday, Election Day. You went out and voted, right?
I did, and I just got to learn what a spoiled ballot means. It turns out I voted for someone, there's these district judges that you have to vote. Do you want to keep them in office, yes or no? For one of the judges, I said yes and no by mistake. So I had to go back, tell them, I screwed up basically. And they said, oh, you have to go and tell, the election monitor that the ballot was quote unquote spoiled, and they'll give you a new one. So I did that as well.
Well, you're just very indecisive. Very indecisive, apparently, there. Yeah, I have not voted yet, but I will. My kids are home. It's weird. Like, when we were kids, I don't think we ever got election day off, but now apparently kids get election day off, at least in Ohio and in South Carolina, where we used to live. But let's get into it. I mean, there is a ton of stuff to talk about, obviously. We're calling this one the next 6 months, because, yes, the election is here, midterm election. We'll talk a little bit about that, just a little bit, but more of a big picture view that, hey, there are some potential positive things on the horizon. We're going to talk a little bit about seasonality, kind of the strong strength that we continue to see off of those October lows. Then take a look, of course, at the Fed, which we talk about every week, but the Fed is so very important. A little kind of recap of what the Fed just said last week. And obviously the jobs number, which kind of looked a little bit like, what is it? What's the saying about how perfect,
wasn't it?
Yeah, mixed bag, it's kind of little this, little that. So we'll dive in and also talk about the economy. Now, I will say, Sonu, before we start, potentially some bad news. I talked about my dog Thurman on this very podcast many times. Remember, he was a 15-and-a-half-year-old dog. We did have to put him to sleep a couple weeks ago. So this is kind of the first podcast. We did one with Libby last week, which, by the way, guys, if you didn't get a chance to listen to that one, Libby Cantrell from PIMCO joined us to really break down the midterm elections. Please check that out. It was really, really good. But old Thurman, he had to go to doggy heaven, which was very sad, but 15-and-a-half years old. He had a really, thank you. He had a really good run. And we actually put him to sleep on my birthday, which is kind of like not ideal because it's like, that's kind of a shame, but it was time. But I said, I'm not honestly not getting choked up talking about it. I got a little cough here all of a sudden. But I said the best present I got was Thurman letting me sleep through the night, because for about 4 months he got up every night to go pee in the middle of the night. So that was a nice gift from Thurman. But we miss you, Thurman. All right, so Sonu,
is he older than your kids, by the way?
Yeah, he's 6 months older than my daughter, who just turned 15 just yesterday. Uh-huh. So yeah, that's kind of how we knew it. So he was our first baby, so that was a tough one, but he's a good boy. So
sorry.
So let's talk a little bit about the market here, Sonu. The rally continues, right? Stocks have been strong from those October lows. What's one thing, maybe you probably didn't see this coming, what's one thing that surprises you about this rally that we have seen since, I guess, October 12th was the closing low? Since October 12th, what surprised you about the bounce here?
One thing we've seen this year is, bonds have had the worst year, right? At least since recorded history, since the 70s, right? And that's hit the equity market too, because normally one zigs, the other zags, right? And we've seen both going down over most of the year. What's positive over the last couple of weeks, 2, maybe 3 weeks, really? Bond yields have continued to go up, which means bond prices, go down when yields go up. So bond prices have continued to go down, but equities have rallied, right? So that's kind of a good thing. It's nice. It's a nice, pleasant surprise, really. That's especially since it's been out of character considering what's happened before the beginning of the year all the way through September, really. I think that's been a bit of a surprise for me.
Absolutely. And I guess we'll call this a pleasant surprise. There's a lot of stocks out there. And you think about it, for the longest time, we heard how, it's just those 5 big stocks, those bang stocks, those 5 going up. Nothing else is going up. Well, now it's almost like a mirror image because those five stocks are
Mhm.
struggling. The FANG stocks are struggling, no doubt about it.
Yep.
But a lot of other stocks are actually going up now, right? It's a stock market. Yes,
Right.
I'd say it's a market of stocks. You look at small caps. There's a ton of small caps out there. Small caps all of a sudden are really starting to do well. Industrials, as we talked about, healthcare, even financials are really starting to take the baton and lead. So again, it's not perfect, but we are really seeing broad based strength for a change. And everyone complained for the longest time about the only five stocks going up. Now it's almost like they've forgotten that there are other stocks out there that are doing well, right?
No, absolutely. It's amazing how tech and tech companies, right? Your Apple, Microsoft maybe
Yep.
less so. It's more important for businesses, right? Like, I know you and I communicate on Teams all day, and we use Word and PowerPoint and all that. But between Apple, Google, Netflix, Facebook, or Meta, what are we calling it? Like, I still say Facebook, so I'm going to stick to Facebook. They loom so large culturally as well, right? In addition to the fact that the weight in the S&P 500 index is so large. But, the other day, the Wall Street Journal had an article saying that Meta or Facebook is going to lay off a ton of people, right? And you think, oh my God, that's horrible, obviously, for all those people. But, you zoom out a bit, and then we're going to talk about the employment report, and that was positive, right? It's a reminder that tech's not the only industry in this economy. All right. You get
No.
industrials too. I mean, you got people making machinery, which is used to build stuff. You talk about your Caterpillars of the world, John Deere's. These companies are doing well. And that's actually a good sign for the economy too.
Yeah, it's funny you mentioned John Deere and Caterpillar, and so we had a tree branch kind of in the way of our basketball hoop at this new house. We had to get the branch down, so I got some tools, and I wanted to buy a chainsaw, right, to chop up this
Oh,
wood, and my buddy would
don't we
not
all?
let me buy. Yeah, my buddy would not let me buy a chainsaw. I said, "No, you don't deserve. You're not up for having a chainsaw," knowing that I probably can barely do anything when it comes to machinery. So anyway, but yeah, nonetheless, we got the branch down, and we got some hand saws and got it there. So now we can play basketball. But anyway, so
There you
yes,
go.
there's a lot of other factors that are out there. But again, we called this week the next 6 months. Just from a seasonality
Right.
point of view, guys, we all hear about sell in May, go away. The worst 6 months are from May until Halloween. Well, something we haven't heard a lot about is the best 6 months are right now, right? November through April, historically really strong. And in a midterm year, we've talked a ton about how midterm years tend to be weak early, but strong late. That's playing out with the 14% bounce we saw in the Dow, literally the best October ever for the Dow at one of the best months of all time. We looked previously 10% bounce in the Dow. The futures returns are really strong. But just looking at the next 6 months, these next 6 months in the midterm year have been higher every single time since World War II. Now, not all of them were massive gains, but a lot of them were pretty strong. So it is more of a tailwind. And it's one final thing here. It is midterm elections, as we said, midterm election season by the time you listen to this. If you look at the day of midterm elections and go out a year, right? So now I'm talking 12 months out versus 6, higher every single time again since World War II. So, Sonu, is it as simple
Incredible.
as the seasonals are just that strong and we shouldn't ignore it? Or, I mean, it's never that simple. I get it, but I wouldn't want to ignore it, right?
I mean, I've started thinking so much more about this since, reading all the great stuff you put out, and, a lot of the blogs you've written about as well, since it's seasonality, right? And it's hard to pinpoint exactly, like, wait, all these years are so different, right? 2010 was different, and 1994 is different, and 2018 is different. Here we are 2022, and we're talking about the Fed, and they're raising interest rates, and there's a 4 decade high inflation, all of that. It seems like, but wait, the seasonality thing, it just seems to occur. I mean, that's why it's called seasonality, right? Same thing happening over and over again, and it's hard to discount that. But I wonder if part of it is, we have a big event like the election, right? And going into it, there's uncertainty, obviously, and people are like, yeah, we're a little worried about how things may play out, the uncertainty that's surrounding, policy implications, all of that. So maybe people hedge a lot, right? Because they don't want to go, dare I say, fully exposed into that event. And so they hedge, right? To, hedge for potential market breakdowns. And then once the event is passed, they take the hedges out, right? And then
Right.
it's like a slow burn up. I mean, I'm not even bringing options and all this into it, but I wonder if there's something to that, and why the seasonality plays out, regularly.
Yeah, I think so too. Markets hate uncertainty, right? And before a
Hmm.
midterm election, there's a good deal of uncertainty. And again, again, listen to last week's podcast with Libby, where we really broke down kind of some of the what could happen with the election, and if this happens, what could happen next. Because again, the time of recording this, we don't quite know yet. But again, the truth is this: once you get over the election, right, the election matters. We're not minimizing that, but the uncertainties out of the way, and if you kind of have those checks and balances, not too much sway one way or the other, which is what we expect to happen here, that could still be a pretty positive tailwind. Some other tailwinds, you think about it. This year, we came into this year, the China zero COVID, China shutdowns, China lockdowns continued, the terrible war that we have going on, obviously, between Ukraine and Russia. Just before we started recording this, and we'll see where it goes from here, but there's talks of potentially some real constructive talks between Ukraine and Russia. But the one I want to focus
Right.
on, because it's so new, the one I focus on is China zero COVID. There's talk China might move off of that. And we saw a enormous rally in copper last Friday, like one of the largest one-day rallies ever of hopes China reopens. I mean, we know all the bad stuff out there, but if China reopens, that could be a positive, right?
Yeah, a massive positive. And I think that's another signal in a sense, right? Because China's had a zero COVID policy, and which means, time after time, just as you think, oh, COVID is done with in some way or form, some shape or form, parts of China just shut down again. And then it's
Yep.
back to square one, right? And factories are closed, supply chain issues, et cetera, et cetera. And if you think markets are bad in the US, both the equity market and the bond market, Chinese market has just been outright horrible, right? But I think people are just looking for that, one positive sign. And these are rumors, right? Let's be clear. It's
Mhm.
not like official China has come out and said, oh, we're not doing COVID zero. In fact, I think the official line is they're still under, COVID zero is their official policy, right? But there are rumors that they're going to slowly phase it away and the market just, takes off to the races. I think it's a sign that they're looking for something bullish, some positive signal here, right? And you mentioned copper. Copper is up about what 10% or so over the last few weeks. Again,
Yeah.
same thing, right? If China opens up, they're going to need a lot more raw materials. I think copper is known as Dr. Copper in some circles, right, Brian? It's got a PhD in economics. Basically, as I said, it's used as an input in a lot of industries. And if economies are doing well, there's a lot more industrial production, and that means they need a lot more copper,
Oh,
right? And that's why
absolutely.
copper prices go up.
Yeah, and you just think about it. Copper's going up, industrial metals are going up. It's probably not a bad sign for the global economy. But we
Right.
want to kind of wrap this discussion up with something I thought was fascinating. Our friends at JP Morgan Asset Management put it together, and they take a look at when stocks bottom relative to earnings bottoming, GDP bottoming, and payrolls bottoming. And we've talked about this before, but the charts they put together were great. And the bottom line is stocks bottom well before earnings turn higher, GDP turns higher, and payrolls turn higher historically. They looked at 1957 recession, 74 recession, the 80s recession, 1990 recession, and the financial crisis. Every single time, stocks started to bottom and rally well before those other things that really do matter started to bottom and go up. So again, what are we seeing now? Right? We're still not seeing
Yep.
things aren't great, but stocks are starting to go higher. So this is what history's told us. Now, I will say the tech bubble was the only time this didn't work. Stocks bottomed after some of these other things turned higher. So it's not perfect. But again, Sonu, I guess the concept being, last question for you, could we be seeing history repeat with stocks go up before the news is good? And that's why investors need to remember this is how history works, right?
Yeah, and stocks are forward looking, right? At the end of the day, markets are
There you
always
go.
looking at, we get the data, sure. The data is from, we just got GDP, a couple of weeks ago, but that was for the last quarter, right? We just got the employment report. That was for the last month. But stocks are like, wait, we're looking ahead. Like you said, it's not like investors get it right. In fact, they get it wrong a lot too. But historically, it's a forward-looking mechanism, really, more than anything else.
Yeah, I'll never forget, April, May, June of 2020. Some of the worst headlines our country has ever seen. Some terrible things were going on. Yet what happened? Those of us that remember, the stock market was soaring higher. And again, it saw, potentially some better times down the road, or maybe it was just as simple as it saw more stimulus down the road. Whatever it was, the stock market, we're not
Right.
going to argue with, and it was right. And that's a 120% rally off those lows, which led to then the bear market of about 25% we've seen this year, but likely we think some better times ahead. So Sonu, let's move forward. Before we do though, what do I want to point out here? I went to showing how the economy's opening up. Had some good friends come up from Charlotte. Went to the Bengals and Panthers game, and I don't know if you can see in the
Nice.
video. I've got a little sun. I mean, we're in Ohio. It was like 80 degrees, like record high out there in the sun.
Wow.
Just watching the Bengals, who are, I mean, don't want to make this all about sports, but they looked terrible on Monday Night Football. Then they looked amazing this week. So talk about schizophrenic. The market's schizophrenic. My Bengals are too. But I got some sun out there in the sun. Now, Soto, I believe one time we talked about F1 is your sport, right? The racing is that?
Yeah, racing, and
yeah,
I did quick background, right? I went to Purdue and I went to Purdue's aerospace school. I switched to mechanical and then I switched to finance. Long story there. But yeah, I did aerospace engineering to get into, I was really interested in Formula One racing, and still am. I'm watching. Obviously, I'm not involved in the sport. I'd love to be, but which is not to say things aren't going well at Carson. But no, Formula One is is huge, and we have 3 races in the U.S. now, so that's been exciting. And we've had one in Austin for years, and there's been another one in Miami. Next year is going to be a brand new race in Vegas. But speaking of that, I'm also, a big fan of soccer. And so the World Cup is coming. It's just around the corner in a couple of weeks. So that's really exciting.
Some good stuff going on there. Let's keep the good stuff rolling here. Let's move forward. Well, maybe it's not necessarily good stuff, but the Fed had a very important, the most important, right, interest rate hike of them all, right? Everyone's important. 75 basis points, the 4th time in a row. They came out. Here's my question to you, Sonu, I guess, because that came out. And then the statement came out, and for 30 minutes, everyone said, good. They're dovish now. They're opening the door to a 50 basis point hike in December, maybe stopped hiking so much in early next year. And then the Q&A happened. Chairperson Powell started to talk. Downhill. Yeah, sort of. It did big time sell off because it almost seemed like he was the exact opposite of what the statement was saying. I'm still confused, and maybe the market was confused. That's why we sold off initially. We have bounced since. What in the world happened last Wednesday with the statement saying one thing and Powell saying another?
Yeah, look, as you said, they raised rates by 75 basis points, 0.75%, right? That's a 4th big 0.75% hike they've done this year. But everyone knew that. They were expecting that. And so the big eye, everyone's focusing on, okay, what are they going to do next, right? Speaking of forward looking, right? We were just talking about that. And, the first thing that comes out after the announcement is the statement in which they added a new line in there saying that, for future interest rate increases, they'll take into account, the cumulative amount of tightening they've already done, by how much they've raised interest rates by a lot, by about 4% this year. And they understand that these are going to impact the economy, inflation, and financial markets with a lag, right? So they need to sort of give it some time, which means, essentially they were saying, look, we're going to decelerate the pace of hikes. Instead of raising interest rates by 0.75% in December, maybe the implication is we go down to 0.5%, right? And then we get down to 0.25. And look, realistically, they weren't, they can't keep doing 0.75% meeting after meeting after meeting. That has to end at some point, right? But I think the statement is also clear. Look, they're still committed to returning inflation to 2%. And then Powell comes out and he reminded everyone about that they're committed to fighting inflation, right? And he kind of tried to separate the fact that, don't worry about, or don't be focused on rather, how fast we're going or whether we're going to slow down or not. Focus on the fact that we have to go high, and how, we may have to go higher than we expected back in September, right? In September, they expected to go as high as maybe 4.6%, which is their benchmark rate, the federal funds rate, which is the rate at which banks borrow from each other to settle their accounts. Now they think maybe that should be higher than 4.6, maybe closer to 5%. And what's interesting is, look, the market knew that already. The bond market knew that. Right? The bond market is pricing that in. So it wasn't like new news in a sense. It's as the stock market acted as if, oh my God, this is all new, right? But really, the bond market knew about that, and they were pricing all that in. So I don't think we learned anything new with respect to what happened, except for the fact that the market is still, to use your words, schizophrenic and going one way or the other. It's not it's not accepting any nuance really, right? It's either 1 or 0.
That's a great point there. And, speaking of the market, I guess I was thinking, so we did see a sell-off on Wednesday, but then by Friday, we had some buyers step in. It's actually the third consecutive Friday. The S&P gained at least 1%. You got to go back 15 years, the last time we saw that. And just remember, in August and September, big time selling on a lot of Fridays ahead of the weekend as no one wanted to hold. So again, it's a little subtle change. Now, Sonu, one thing, we just had Halloween, right? We just had Halloween, and we'll talk about maybe something that scares us. One thing that scares me, our friends at Pantheon Research pointed this out. They looked back and they found that like the last 8 or 9 rate hiking cycles, what the Fed did, they hiked rates, right? And then once core CPI rolled over, they never hiked again. They stopped hiking. Right. Yeah. Core CPI rolled over. They've never hiked once core CPI rolled over. Is what I'm trying to say there. They give the medicine to the patient, let the patient get better. It's a very good chance core CPI rolled over as it peaked in September. And they're still hiking, right? They're still hiking in December, maybe even early next year. This is the first time we've ever seen a Fed this aggressive. I got to be honest, I'm a pretty optimistic guy. I still think, believe me, what we talk about here, we think stocks are a good value, and this bull market, we could have a pretty good bull market on our hands, and people don't realize it yet because a lot of stocks are going up. But I will say I'm worried when I see the Fed has never done something before, and they continue to hike as inflation likely has rolled over. Do you have anything you want to add to that? Because I don't know if I do, other than it does concern me.
No, I think that's a risk, right? Normally you think, if you just forget the Fed, right? If you just take all the data that's coming out.
Thank you. Forget the Fed. I think that's what we should title this. Forget the Fed.
So you'd say, I mean, I know, okay, setting aside inflation, look at all the numbers. You look at employment, you look at industrial production. Manufacturing is slowing a bit, but it's still, stronger than it was actually. It was as strong as maybe it was pre-crisis, right? And there's certain aspects of it that like, delivery times, that's improving. So that's a positive with respect to inflation. You look at rental prices, right? Actual market rents. I'm not talking about what the government measures, but actual market rents are falling. Demand for rentals are falling, right? So you look at all of that and I think, okay, the economy is not, certainly doesn't look like a recession, right? But then now you account for the Fed and you think, oh, they keep ratcheting things up and up and up. And odds are they break something. But I think it's a risk. It's not a certainty, right? I mean, one thing interesting is that I think most economists on Wall Street, not everyone, most of them are, predicting a recession next year, which is about 63% probability for a recession next year. And Ryan, I know you keep track of, you always say, what's that saying by general pattern? Like if everyone's on one side, maybe you should look to the other side.
If this would be the most thinking alike, somebody isn't ever. Thinking.
Yeah, so this will be the most predicted recession. Yeah, right. Or if you think back to 2008, even in summer of 2008, there were a lot of economists on the street saying we're not in a recession, right? And so you think about that versus what's happening now. Like, wait, everyone's seeing this recession, everyone's predicting a recession. I mean, are we that sure, really? I mean, I don't think so.
Yeah, or I think I'll put it like this. If we have a recession, it's probably going to be a mild recession. I think the economy is in pretty good shape, like we talked about. Yeah. Parts of it are not in a recession at all. Just get on an airplane, go to a steakhouse in a nice city. They're packed, right? I mean, that's not like a recession. But the market's pricing in a recession, down 25% on the S&P, more small caps, more NASDAQ, more of those big cap tech names. So just kind of that's some interesting points to point out. Also, you mentioned how rents actually had a big drop in October, like 0.7% month over month, one of the largest monthly drop in rents we've ever seen. And which company does that, Sonu? It's the apartment list. Apartment list just came out. Also, Manheim Used Cars Index. We've talked about this one before. It's down 5 months in a row, down. I've got it in front of me somewhere. 10.6% year over year. That's like the largest year over year drop we've seen in used cars. So used cars coming down, rents coming down. These things are going to get into the government's data eventually, which in our opinion suggests, again, inflation is probably going to really start to come back to earth. We'll see. Maybe by the time people listen to this, that CPI report will be out. But as we head into the future, seeing rents and car prices lower are two huge parts of inflation, right?
No, absolutely. And again, timing it is difficult, right? Like, as you said, there's a inflation report coming out the week that we're recording this. And will we see the deceleration in, that will be the October inflation report, right? Will it happen in October? I don't know. But by the time we get 6 months from now, or even 4 months from now, I think we'll start seeing that deceleration.
Yeah, absolutely, which should be a nice tailwind. So the final thing we wanted to talk about this week, got about 5 minutes or so, that jobs report, right? The jobs report came out 261,000, better than expected. But Sonu, you took a look and you broke it down and you found, some positives and some negatives in the jobs report. Talk to me about those.
Yeah, what's interesting is when we say jobs report, it's actually two reports, right? There's one survey, which is actually called the establishment survey. That's where this non-farm payroll data comes from, right? That's, as you just quoted, you saw, 261,000 jobs created in October, right? It's a survey of about 130,000 plus businesses. It represents about, just under 700,000 work sites. So it's a big survey, right? Now, the other thing is they can go back and revise it. And we've seen that in the past. And there could be significant revisions, especially as we go through down the years, right? Now, the other survey is what's called the household survey. It's smaller than the establishment survey. And because of that, the numbers tend to be more volatile. It's a survey of about 60,000 households, still big, but it's just smaller than the other one. It gathers information on employment, unemployment, other labor force related data, age, education, part-time, full-time status, things like that, right? That's where the unemployment rate comes from. And we saw that increase from 3.5% to 3.7%. Why? Because more people got unemployed. So on one side, you had 261,000 jobs created net, right? And on the other side, the household survey reported that there were job losses of about 328,000. So that's a big difference, about close to 600,000, right? The difference between one and the other. But, we've seen that historically. We've seen that, in fact, in April and June of this year. Even back in January, the household survey, the more volatile, survey, showed jobs created of 1.2 million. And, the non-farm payroll report, the establishment survey, was about 500,000. That's a big difference of about 700,000, right? Big picture reality is, look, they converge over time. And we've seen that over the last 2 years, right? One races much faster than the other, and then it comes back. The other one catches up, and then the other one goes forward. And then the other survey catches up, right? So this happens over time. The big picture, look, I think the employment picture is still strong, right? And good news, at least from the Fed's perspective, I think is wage growth is decelerating, right? Yep. Wages aren't growing, as fast as they have been in the past. And I think a big piece of that is people are quitting their jobs less, right? Big reason for wage growth, accelerating as much as it did over the last couple of years is after the pandemic, a lot of people quit their jobs. They were quitting to go to a new job, which paid a lot more, right? And now there's less of that, right? So I think
just jump
wage
in,
growth, that pressure is going down.
This is the joke that this was the first recession in history where everybody quit their job to go make more money at another one. I mean, that's it's kind of what it was.
And make no mistake, they're still doing that, right? To an extent, that's still happening more than it happened before the pandemic, but it's slowing. That's the good news, at least from the Fed's perspective.
Yeah, you mentioned these two reports, about 600,000 jobs difference. That's about the size of the city of Omaha, right? So you're talking a pretty substantial difference between those two. But again, 261,000 is one of the lowest numbers of jobs growth we've seen in a long time, which again is what the Fed wants, right? The Fed, what they're trying to do, and some of maybe the last things we need to wrap up here. What the Fed is trying to do is they're trying to slow things down enough without breaking the system, right? They want these jobs to slow down. They want jobs growth to slow down. They want wages to slow down, but they don't want to send us directly into a massive recession. Now, they unofficially said it. They might be okay with a mild recession if that breaks the back of inflation, because it took 2 recessions back in the early 80s to break inflations back then. We don't think we're quite in that scenario. But again, the Fed doesn't want to break things. Do you think this report opened the door for the soft landing, or is it going to be harder for a soft landing? Where do you stand there? Last question.
I think, given what happened in this report, I think I would raise my odds for a soft landing. I'm not saying that's a certainty, but I think the probability of that went up. I mean, look, as you said, what the Fed's trying to do is get on top of inflation. Now, how do they do that? They need to make sure that people spend less and put less, so there's less demand for goods and services, right? Now, where is that, spending pressure coming from? That's coming from income growth, right?
Yeah.
And if you think about income, overall income in the economy, there's three things there, right? One is how many people are working, how many hours are they working for, and how much are they earning per hour, right? You multiply all that, and that gets you to overall aggregate income in the economy, right? Which puts pressure, that leads to more spending, that leads to more inflation. That's the Fed's story. And the Fed's saying, okay, we need to pull that back. We need to lower, overall income. Few ways you can do that, right? Two big ways are, the amount of pay people are earning per hour, that goes down, and that's happening. And then the other side is let's make sure employment goes into reverse, right? If employment gains start going down, maybe negative, you really start to see a deceleration in incomes, right? The good news is we are seeing that earnings growth go down without employment gains going negative, and I think that's very positive.
No, I think you're right. I think there's a better chance of a soft landing than a lot of people give credit. Is kind of where I am. And maybe one final reason that maybe we don't have a recession next year is this whole Taylor Swift thing. I don't know how old your daughter is. You got a 6-year-old daughter, correct?
6-year-old. So is
she into Taylor Swift at all, or
maybe?
Probably not?
Taylor
yet. Swift, she a fan? Okay, so my daughter just turned 15. To say that she's a Taylor Swift fan is an insult. I can sing like every Taylor Swift song because she plays it every time. Anyway, Taylor Swift's announcing this huge tour. What I'm getting at, it's crazy. Like hotels, cities are going, like, it's ruining people's weddings because the weekend is the same as Taylor Swift. So I don't see how we're going to have a recession when Taylor Swift is taking over the country next summer.
As a big tour.
People out there.
So are you going?
Goodness.
Have you gotten tickets?
I'm not. I'm just paying for. I'm just financing it. I think I'm financing a couple of them. I think we're going to maybe go to Pittsburgh and one in Cincinnati. That's where my daughter's pretty excited. She's a great daughter. So great girl. She deserves it. Although I don't know, these prices are getting up there. But anyway, nonetheless, if you know what I'm talking about, you know what I'm talking about. This Taylor Swift thing is crazy with this tour. So everybody, thanks for being here. The 9th edition of the Facts versus Feelings podcast with Ryan and Sonu. Hopefully you enjoyed it. We appreciate it. If you like this, give us a like, give us a follow, give us a positive review. It does help us continue to build this podcast and continue to build this brand. So with that, everybody, we'll see you next week. Take care, everyone. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Derrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.